What if I told you that just a few men, sitting in quiet offices, made decisions that pushed the entire world into the worst economic disaster in modern history? No wars, no natural disasters, just policies, misjudgments, and a deep belief in a system that no longer worked. This is the story of Lords of Finance and how four central bankers helped shape the Great Depression. Let's go back to the early 20th century. The world had just come out of World War I. Europe was devastated, economies were unstable, governments were trying to rebuild, but the financial system was fragile. At the center of everything was something called the gold standard. Under this system, every country's currency was tied to gold. If you held money, you could exchange it for a fixed amount of gold. It created a sense of stability and trust. But there was a catch. Governments couldn't freely print money. Their economies were limited by how much gold they possessed. In times of crisis, this restriction could become dangerous. Now, meet the four men at the heart of this story. Montagu Norman from the Bank of England, Benjamin Strong from the US, Federal Reserve, Hjalmar Schacht from Germany, and Émile Moreau from France. These were not elected leaders, they were central bankers, but their decisions affected millions of lives across the globe. After World War I, the global economy was out of balance. Germany was forced to pay massive reparations. Britain was struggling to maintain its financial power. France wanted security and stability, and the United States had emerged as the strongest economic force. Instead of creating a new system suited for this new reality, these leaders tried to restore the old one, the gold standard, as if the world had not changed. This decision would have serious consequences. The gold standard required discipline, but in a fragile post-war world, it demanded too much. Countries began raising interest rates to protect their gold reserves. They cut spending. They reduced wages. These actions were meant to stabilize currencies, but instead, they weakened economies. Among the four bankers, Benjamin Strong stood out. He understood that the global system needed support. To help Europe recover, he kept interest rates low in the United States. This made borrowing easier and encouraged investment. For a while, it worked. The 1,920 seconds became a period of rapid growth, especially in the United States. Businesses expanded. The stock market soared. Confidence was high. But beneath the surface, risks were building. Easy money led to excessive borrowing. People began investing heavily in stocks, often using borrowed funds. Prices kept rising, not always because of real value, but because of growing optimism. This was a classic financial bubble, and like all bubbles, it was bound to burst. In 1928, Benjamin Strong died. His absence created a leadership vacuum. Coordination between central banks weakened. At the same time, the Federal Reserve began raising interest rates to slow down speculation in the stock market. This decision had global effects. Credit tightened. Investment slowed. Pressure built within the financial system. Then, in October 1929, the stock market crashed. Panic spread quickly. Investors rushed to sell their stocks. Prices collapsed. Banks began to fail. Businesses shut down. Confidence disappeared almost overnight. But the crash itself was only the beginning. The real tragedy came from the response. Instead of easing the crisis, central banks focused on protecting their gold reserves. They kept interest rates high. They refused to increase the money supply. Why? Because they believed maintaining the gold standard was more important than stabilizing the economy. This decision turned a financial crisis into a global catastrophe. As money became scarce, spending dropped. Businesses could not survive. Unemployment rose sharply. In the United States, nearly 1 in 4 people lost their jobs. Across Europe, the situation was just as severe. Germany was hit particularly hard. Its economy depended heavily on loans from the United States. When those loans stopped, its financial system collapsed. Banks failed. Industries shut down. Millions were left unemployed. The economic pain created deep social and political instability. France, on the other hand, chose a different path, but it also made things worse. Instead of circulating money, France began accumulating gold. It held on to its reserves tightly, reducing the amount of money flowing through the global economy. This made deflation even more severe. Britain struggled to maintain its position. It tried to keep its currency tied to gold at a high value, which made its exports expensive and uncompetitive. Its economy suffered. Eventually, in 1931, Britain was forced to abandon the gold standard. This marked a turning point. Slowly, other countries began to follow. In the United States, The situation reached a breaking point by 1933. Franklin D. Roosevelt became president and introduced bold changes. He took the country off the gold standard. He allowed the money supply to expand. He launched economic reforms aimed at recovery. These actions helped stabilize the economy and restore confidence. The lesson was clear. The gold standard, once seen as a symbol of stability, had become a barrier to recovery. By clinging to it for too long, leaders had deepened the crisis. Lords of Finance shows us that economic disasters are not always unavoidable. They are often shaped by human decisions. The four central bankers believed they were doing the right thing. They followed the rules they trusted, but they failed to adapt to a changing world. Their lack of flexibility, their poor coordination, and their commitment to an outdated system turned a downturn into the Great Depression. This story is not just about the past. It is a reminder of how powerful financial decisions can be. It shows how a small group of individuals can influence the lives of millions, and it highlights the importance of learning, adapting, and questioning established systems when circumstances change. Because in the end, the greatest risk is not uncertainty. It is the refusal to change when change is needed most.